Chapter 1 Introduction to Partnership. Number 1 Introduction. The partnership firm is emerged from capital and managerial limitations of sole proprietor firm. Following are the reasons for the emergence of partnership firm. Number 1 An individual has sufficient funds but does not have required skills. Number 2 An individual has required skill but does not have sufficient funds. Number 3. To distribute business risk. More than one person, additional capital, skill, and managerial ability are required to run a business at a large level and for the expansion of any business. In these circumstances, more than one person gathers and becomes the supplement to each other and commences a business. This form of business organization means a partnership firm. Number 2. Meaning and definition of partnership. Section 4 of the Indian Partnership Act 1932 defines partnership as partnership is the relation between the persons who have agreed to share the profit of a business carried on by all or any one of them acting for all. The people who enter into such relationship are individually called partners and collectively a firm. From the above definition, it can be said that two or more persons who are competent to undertake a contract to earn profit from a legal business, the business is termed as partnership. The business run collectively in partnership by two or more persons is known as partnership firm. Number 3. Characteristics of partnership. Number 1. Creation by contract. Partnership emerges through agreement. Partnership agreement can be in written or oral form, but written form is desirable and advisable. Number 2. Profit objective. Partnership firm forms to earn and distribute profit. The distribution of profit or loss is done amongst partners in their predetermined proportion. As per Partnership Act, profit or loss is distributed in equal proportion if no provision is made in the contract. Number 3. Legal business. Partnership firm is formed to do a legal business. Number 4. Agent of each other. The business of partnership firm is run by all the partners or any one of them for all or more than one partner. Thus, each partner is an agent of each other. Number 5. Number of partners. The Section 464 of the Companies Act 2013 empowers the government to prescribe maximum number of partners in a firm subject to maximum of 100. The government has prescribed maximum number of partners in a firm to be 50 with Rule 10 of the Companies, that is Miscellaneous Rules 2014. Number 6. Unlimited liabilities. As per Partnership Act, partners are responsible to pay business obligation from their personal property when the firm does not have sufficient assets to pay liabilities of the business. Every partner individually and collectively is responsible to the partnership firm. Therefore, the liability of each partner is unlimited. Number 7. Ownership and management of firm. Partners are owners of business and they do the management of business. The management of business is done either by all the partners or by one partner or by more than one partner. Number 4. Partnership deed. The emergence of partnership is from the agreement. Partners undertake agreement within the provisions of Partnership Act. Partnership deed acceptable to all the partners is prepared at the time of the commencement of a partnership firm. The partnership agreement can be written or oral. A written agreement of partnership is known as a partnership deed. A written partnership deed is desirable and advisable so that the solution of any misunderstanding or dispute in future can be obtained on the basis of the provisions of the partnership deed. The partnership deed is an administrative constitution of partnership firm where all provisions pertaining to firm's administration are included. Generally, the following content is included in the partnership deed. Number 1. Details of partners. The information about name, address and other details of partners is included. Number 2. Details of firm. The details like name and address of the firm are included. Number 3. Type of business. The information about the type of business is also included here. Number 4. Commencement of partnership. The information about the commencement date of the partnership firm is also covered in the deed. Number 5. Capital. The amount of capital introduced by each partner is mentioned in the deed. It is not mandatory to bring a capital by each partner. Number 6. Interest on capital. Whether interest on capital is to be paid or not. If yes, then what percentage? These points are mentioned in the partnership deed. If no provision is made in partnership deed, no interest on capital is paid to the partners. Number 7. Drawings. What maximum amount can be withdrawn by each partner is also mentioned in the partnership deed. Number 8. Interest on drawings. At what rate interest is to be charged on drawings made by the partner during the year is also mentioned in the partnership deed. There is no provision in the Partnership Act for the interest on drawings, but if necessary, such provision can be included in the partnership deed. Number 9. Distribution of profit and loss. In which proportion profit or loss of business will be distributed among the partners is provided in the partnership deed. If no provision is made in partnership deed, as per the Partnership Act, profit or loss is distributed in equal proportion. Number 10. Salary, bonus, commission and remuneration to the partners. There is no provision in Partnership Act for the payment of salary, bonus, commission and remuneration to the partners. If any partner takes active participation in the management of the partnership firm, a provision is made in the partnership deed for the payment of salary, bonus, commission and remuneration to the partners. Number 11. Interest on loan provided by partner to firm. The rate of interest is to be mentioned in the partnership deed when any partner has lended a loan to a firm. If no provision is made in them, partnership deed, as per the Partnership Act, 6% per annum interest will be paid on the loan given by the partner to the firm. Interest on partner's loan is treated as an expense of business. Thus, it is debited to the profit and loss account. Number 12. Goodwill. The computation to determine the value of goodwill at the time of the admission of a new partner and at the time of retirement or death of a partner is also mentioned in the partnership deed. Number 13. Admission, retirement. The provisions pertaining to admission of a new partner and the retirement or death of a partner is also mentioned in the partnership deed. Number 14. Dissolution of firm. In what circumstances firm will be dissolved, what procedure will be adopted, etc. These points are mentioned in the partnership deed. The payment of salary, bonus, commission, remuneration or any other payment only to active partners of a partnership firm is available as deduction as per Section 40, subsection B of Income Tax Act 1961. As stated in Section 40, subsection B of Income Tax, any interest payable to partners will be disallowed if no provision is made in the partnership deed. Therefore, it is desirable to mention it in the partnership deed. As per Section 40, subsection B 4 of Income Tax Act, interest payment more than 12% to the partners will not be given as deduction. As per partnership deed, interest more than 12% can be paid, but deduction will be allowed up to 12%. Number 5. Provisions of Indian Partnership Act 1932 pertaining to accounting treatments in the absence of partnership deed. The following provisions of Partnership Act 1932 will be applicable if no partnership deed is prepared or no clarification is made in the partnership deed. Number 1. Each partner contributes capital in the firm by mutual agreement. There is no restriction in the Act in this regard. it is not mandatory to bring a capital for each partner. Number 2. Interest on the capital of partner cannot be paid. Number 3. The distribution of profit and loss would remain in equal proportion. Number 4. Interest on drawings of the partner cannot be charged. Number 5. Salary, bonus, commission or remuneration cannot be paid to the partners. Number 6. 6% per annum interest is payable for the loan given by any partner to the firm. Number 7. In case of any reasonable expense incurred by the partner for the firm, the partner has to write to reimburse it. Number 6. Capital accounts of partners. A capital account of each partner is prepared in the books of partnership firm to record the individual transactions done by the partner with the partnership firm. An initial capital introduced by the partner and addition in capital in any means are recorded at the credit side of the capital account, and transactions which reduce the capital are recorded at the debit side of the capital account. There are two methods to maintain capital accounts in the books of partnership firm. Number 1. Fluctuating capital account method. Number 2. Fixed capital account method. Number 1. Fluctuating capital account method. A method in which the opening balance of the capital account and the closing balance of the capital account of any partner is reported fluctuated, that is, flexible, is known as fluctuating or temporary capital account method. Under this method, to record all the transactions related to the partners, only one capital account is prepared in the books of firm. Opening capital, additional capital introduced during the year, interest on capital, salary, bonus, commission, remuneration, interest on loan given by the partner, share of partner in divisible profit are credited at the credit side of the capital account. Drawings, interest on drawings, share of partner in divisible loss are debited at the debit side of the capital account. To record these transactions, partners' capital account are debited or credited, keeping in mind the nature of transaction. Consequently, during the year, there is either increase or decrease in the opening balance of the capital account. So the balance of capital account of any partner keeps on changing every year. Thus, this method is known as fluctuating or temporary capital account. All transactions between the partners and the partnership firm are recorded in the partner's capital account. Under this method, balance of partner's capital is either credit or debit. If there is credit balance in capital account, it would appear at the liability side of the balance sheet, and the debit balance would appear at the asset side of the balance sheet. A specimen of partners' capital accounts under fluctuating account method is as under. Partners' capital accounts: debit, credit. Date: particular, A amount rupees, B amount rupees. Date: particular, A amount rupees, B amount rupees. Debit side: to balance brought down, opening debit balance of capital account, to drawings account, cash or bank any other asset account, to interest on drawings account, divisible loss, to profit and loss appropriation account. On credit side, by balance brought down, opening credit balance of capital account, by cash or bank or any other assets account, by interest on capital account, by salary account, by bonus account, by commission account, by remuneration account, by profit and loss appropriate account. Debit side, divisible loss. On credit side, divisible profit. Debit side, to balance carried down, closing credit balance of capital account. On credit side, by balance carried down, closing debit balance of capital account. 2. Fixed capital account method. A method of partners' capital under which no change is reported in opening balance and closing balance in the partner's capital account is known as fixed capital account method. Under this method, to record all the transactions of the partners with the partnership firm, two accounts are maintained in the books. A. Partner's capital account. B. Partner's current account. A. Partner's capital account. Generally, under this method, opening balance and closing balance of partner's capital account remains identical. There can be change in opening balance and closing balance of partner's capital account if either additional capital is introduced or capital is withdrawn by the partners on the permanent basis. Under this method, balance of partner's capital account remains credit balance. The credit balance of capital account is shown at the capital liability side of the balance sheet. Transactions other than permanent capital are recorded in the current account. A specimen of partners' capital accounts under fixed capital account method is as under. Partners' capital account. Debit, credit. Date, particular, A amount rupees, B amount rupees. Date, particular, A and B. Debit side, to cash or bank, any other asset. Withdrawal of capital, to balance carried down, closing credit balance. Credit side, by balance brought down, opening credit balance. By cash, bank, any other assets account, additional capital. B. Partner's current account. Under fixed capital account method, the account prepared to record the transactions of the partner with the partnership firm other than permanent capital is known as current account. At the credit side of the current account, opening credit balance of current account, interest on capital, interest on credit balance of current account, salary, bonus, commission, remuneration and shares in divisible profit are recorded. At the debit side of current account, opening debit balance of current account, drawings, interest on drawings, interest on debit balance of current account and share in divisible loss are recorded. The closing balance of current account is credit balance. It is shown at the capital and the liability side of the balance sheet, and debit balance is shown at the asset side. Partner's current account. Debit, credit. Date, particular, A amount rupees, B amount rupees. On credit side, date, particular, A amount rupees, B amount rupees. Debit side, to balance brought down, opening debit balance of current account, to drawings account, cash, bank, any other asset account, to interest on debit balance of current account, to profit loss appropriation account, divisible loss account, to balance carried down, closing credit balance of current account. On credit side, by balance brought down, opening credit balance of current account, by interest on credit balance of current account, by salary account, by bonus account, by commission account, by remuneration account, by profit loss appropriation account, by divisible profit, by balance carried down, closing debit balance of current account. Note: when current accounts of partners are not given in the question and no specification is given pertaining to the capital account, in this case, capital accounts are maintained under fluctuating capital account method. Number 7. Difference between fixed capital account method and fluctuating capital account method. Points of difference: fixed capital account method, fluctuating capital account method. Number 1. Meaning: where the opening balance and the closing balance of the partner's capital accounts are reported unchanged is known as fixed capital account method. Where the opening balance and the closing balance of the partner's capital account are reported flexible is known as fluctuating capital account method. Number 2. Accounts. Fixed capital account method. To record all the transactions of the partners with the firm, two accounts are opened in the books of the firm. Number 1 capital account and number 2 current account. Fluctuating capital account method. To record all the transactions of the partners with the firm, only capital account is opened in the books of the firm. Number 3. Treatments of transactions. Fixed capital account method. In capital account, capital and changes in capital are recorded. Transactions other than permanent capital are recorded in the current account. Fluctuating capital account method. All transactions of capital and other than capital are recorded in the capital account. Number 4. Interest on capital. Fixed capital account method. Generally, the amount of capital remains unchanged. Therefore, interest on capital remains constant. Fluctuating capital account method. The amount of capital keeps on changing. Consequently, interest on capital also keeps on changing. Number 5. Balance of account. Fixed capital account method. Balance of fixed capital account is always a credit balance, while current account can have a debit or credit balance. Fluctuating capital account method. Generally, balance of capital account is a credit balance, but under this method, there can be debit balance of capital account. Number 6. Treatment in balance sheet. Fixed capital account method. Since fixed capital account has credit balance, it will be shown at the capital liability side of balance sheet. If current account has credit balance, it will be shown at the capital liability side of balance sheet and debit balance at the asset side. Fluctuating capital account method. If capital account has a credit balance, it will be shown at the capital liability side of the balance sheet and the debit balance at the asset side. Number 8. Drawing accounts of partners. When partners withdraw cash, goods or assets from the partnership firm for his personal use, this amount is known as drawings of partners. Withdrawal done by the partner from the partnership firm is debited to the drawing account. If provision is made, then interest on drawings is also debited to the drawing account. At the end of the year, in fluctuating capital account method, drawing account is closed and the balance is transferred to the partner's capital account. In the fixed capital method, it is debited to the partner's current account. Journal entry is passed as follows in this regard. Partner's capital or current account debit to partner's drawings account. Being partner's drawings account is closed and transfers it to partner's capital or current account. The specimen of drawings account is as follows. Partner's drawing account. Debit, date, particular amount, rupees. Credit, date, particular amount, rupees. Debit side, to cash account, to bank account, to goods or assets account, drawings done during the year, to interest on drawings account. On credit side, by capital or current account, closing balance is transferred to capital or current account. Note, when interest on drawing is debited to drawings account, it will not be debited to the capital or current account. Number 9. Profit loss appropriation account. To distribute profit and loss amongst the partners, profit loss appropriation account is prepared after the preparation of the profit loss account in final accounts of the partnership firm. Profit loss appropriation is a part of the profit loss account. A separate preparation of this account is not mandatory. Credit side of profit loss appropriation account. At the credit side of the profit loss appropriation account, net profit transferred from the profit loss account. Interest on drawings done by the partners. Interest on debit balance of current accounts of partners are credited. Debit side of profit loss appropriation account. At the debit side of the profit loss appropriation account, net loss transferred from the profit loss account, interest on partners' capital account, interest on credit balance of the current accounts of partners, salary bonus, commission, remuneration to the partners, amount transferred to general reserve account are debited. Allocation of profit loss. After deduction of the total of the debit side of the profit loss appropriation from the total of the credit side of profit loss appropriation, difference, that is profit, is credited to partners' capital or current account in their profit loss sharing ratio. After the deduction of the total of the credit side of profit loss appropriation from the total of the debit side of the profit loss appropriation, difference, that is loss, is debited to the partners' capital or current account in their profit loss sharing ratio. Profit loss appropriation account for the year ending of partnership firm of A, B and C. Debit, date, particular amount, rupees. Credit, date, particular amount, rupees. On debit side, particular, to profit and loss account, net loss, to interest on partners' capital account A, B, C. To interest on credit balance of current accounts of partner, to partner's salary account, to partner's bonus, commission, remuneration account, to general reserve account, to partner's capital account, divisible profit A, B, C. On credit side, by profit and loss account, net profit. By interest on partner's drawings account A, B, C. By interest on debit balance of current accounts of partner, by partner's capital account, divisible profit A, B, C. Note, commission to manager and interest on loan given by the partner are treated as the expense of the firm. Thus, both are recorded at the debit side of the profit and loss account. The principle of matching concept is applicable to both of these, hence are debited to profit and loss account. Detailed information for interest on drawings, interest on capital, and interest on loan of partners is given subsequently. The interest on partners' loan is not mentioned in the partner's capital or current account. Its accounting effect is given separately. The partner's loan is the liability of a business. Outstanding interest on the loan also will be shown as liability in the balance sheet. Number 10. Difference between profit and loss account and profit and loss appropriation account. Points of difference: profit and loss account, profit and loss appropriation account. Number 1. Meaning: profit and loss account. After the preparation of the trading account, the account which is prepared to know the net profit or loss of the business is known as profit and loss account. Profit and loss appropriation account. After the preparation of the profit and loss account, account which is prepared to distribute profit or loss amongst the partners is known as profit and loss appropriation account. Number 2. Prepared by. All business entities prepare profit and loss account. Generally, partnership firm prepares profit and loss appropriation account. Number 3. Opening entry of account. Gross profit or gross loss determined under trading account is shown as the opening entry of the profit and loss account. Net profit or net loss determined under profit and loss account is shown as the opening entry of the profit and loss appropriation account. Number 4. Debit side. At the debit side of this account, expenses other than purchase are recorded, for example, administrative expenses, sales expenses, financial expenses, depreciation, interest on loan of partner, commission of manager, provision and other expenses and loss. At the debit side of this account, interest on capital, interest on credit balance of current account, salary, bonus, commission and remuneration to the partners are recorded. Number 5. Credit side. At the credit side of this account, different revenues of business are recorded. At the credit side of this account, interest on drawings, interest on debit balance of current account is recorded. Number 6. Result of account. From this account, net profit or net loss of the firm is ascertained. From this account, divisible profit or divisible loss of the firm is ascertained. Number 7. Balance of account. The balance of this account is transferred to the profit and loss appropriation account. The ascertained divisible profit or loss is distributed among the partners. Explanation and journal entries for special issues. Number 1. Interest on capital. Journal entry. Number 1. When interest on capital is payable, interest on capital account debit to partner's capital or current account. Number 2. To close interest on capital account and transfer it to profit and loss appropriation account. Profit and loss appropriation account debit to interest on capital account. Number 2. Salary, bonus, commission, remuneration to the partners. Journal entry. Number 1. When salary, bonus, commission, remuneration are payable to partners, partners' salary, bonus, commission, remuneration account debit to partner's capital or current account. Number 2. To close salary, bonus, commission, remuneration and transfer them to profit and loss appropriation account. Profit and loss appropriation account debit to partner's salary, bonus, commission, remuneration account. Number 3. Interest on drawings. Journal entry. Number 1. When interest on drawings is charged, partner's capital or current account debit to interest on drawings account. Number 2. To close interest on drawings account. Interest on drawings account debit to profit and loss appropriation account. Number 4. Profit transferred to general reserve. Journal entry. When profit is transferred to general reserve account, profit and loss appropriation account debit to general reserve account. Number 5. Profit or loss of profit or loss appropriation account. When profit or loss of profit and loss appropriation is distributed among partners in their profit sharing ratio. Number 1. In case of profit, profit and loss appropriation account debit to partner's capital or current account. Number 2. In case of loss, partner's capital or current account debit to profit and loss appropriation account. Number 6. Interest on loan of partners. Journal entry. Number 1. When interest on loan is paid, interest on loan account debit to cash account. Number 2. When interest on loan is outstanding, interest on loan account debit to outstanding interest on loan account. Number 3. To close interest on loan account. Profit and loss account debit to interest on loan. Interest on partner's capital account. There can be different provisions for the interest on capital in the partnership deed. Interest on capital can be paid to the partners as per the following provisions of the partnership deed. Provisions in partnership deed. Interest on capital. Number 1. When there is no provision for interest on capital in the partnership deed, interest on capital cannot be paid. Number 2. When the provision for interest on capital is made in the partnership deed but no clarification is provided to consider interest on capital as a charge or appropriation of profit. Number 1. In case of loss, interest on capital cannot be paid. Number 2. If profit is equal to interest of amount or more than that, in this case, interest on capital can be paid as per the prescribed rate. Number 3. If profit is less than interest on capital, amount equal to profit can be paid as interest on capital to the partners in their capital proportion. Number 3. When interest on capital is considered as a charge as per the partnership deed, that is, in case of either profit or loss, interest will be paid. Whether profit is insufficient or there is loss, interest on capital can be paid as per the prescribed rate. That is, in these circumstances, profit and loss appropriation account would show the divisible loss. A and B are partners sharing profit and loss in the proportion of 4:1. Their capital as on 1st April 2016 is 4 lakh and 2 lakh respectively. Prepare profit and loss appropriation account or profit and loss account, whichever is necessary for the year ending on 31st March 2017 under the following provisions pertaining to interest on capital if prescribed in the partnership deed. Number 1. If a firm has a profit for the year Rs 40,000 and no provision is made for interest on capital in partnership deed. Number 2. If a firm has a profit for the year Rs 80,000 and 10% per annum interest on capital is payable as per the provision of partnership deed. Number 3. If a firm has a profit for the year Rs 30,000 and 10% per annum interest on capital is payable as per the provision of partnership deed. Number 4. If a firm has a profit for the year Rs 30,000 and 10% per annum interest on capital is payable and interest on capital is considered as charge as per the provision of the partnership deed. Number 5. If a firm has a loss for the year Rs 10,000 and 10% per annum interest on capital is payable and interest on capital is considered as charge as per the provision of the partnership deed. Answer. Number 1. If no provision is made for interest on capital in partnership deed. Profit and loss appropriation account for the year ending on 31st March 2017. Debit particular to partners capital account A 32,000, B 8,000. Total amount Rs 40,000. Credit particular by profit and loss account net profit Rs 40,000. Number 2. If provision in partnership deed is made to pay 10% interest on capital. Profit and loss appropriation account for the year ending on 31st March 2017. Debit particular to interest on partners capital account A 40,000, B 20,000, total of Rs 60,000. To partners capital account A 16,000, B 4,000, total of Rs 20,000. Total Rs 80,000. Credit particular by profit and loss account net profit Rs 80,000. Number 3. If provision in partnership deed is made to pay 10% interest on capital. Profit and loss appropriation account for the year ending on 31st March 2017. Debit particular to interest on partners capital account A 20,000, B 10,000. Total of Rs 30,000. Credit particular by profit and loss account net profit Rs 30,000. Note. Payable interest at 10% to A Rs 40,000 and to B Rs 20,000. Total Rs 60,000. While net profit is Rs 30,000. Thus, interest on capital will be paid to the extent of the net profit available. Interest on capital equal to net profit Rs 30,000 will be paid to the partners in their ratio of capital 2:1, that is, rupees 20,000 is to rupees 10,000. Number 4. If provision in partnership deed is made to pay 10% interest on capital and treated interest as charge. Profit and loss appropriation account for the year ending on 31st March 2017. Debit particular to interest on partner's capital account. A. 40,000. B. 20,000. Total rupees 60,000. Credit particular by profit and loss account net profit rupees 30,000. By partner's capital account net divisible loss 4:1. A. 24,000. B. 6,000. Total of rupees 30,000. Total of credit side 60,000. Number 5. If provision in partnership deed is made to pay 10% interest on capital and treated interest as a charge when firm has net loss. Profit and loss appropriation account for the year ending on 31st March 2017. Debit particular to profit and loss account, that is net loss rupees 10,000. To interest on partner's capital account A. 40,000. B. 20,000. Total 60,000. Total of debit side 70,000. Credit particular by partner's capital account net divisible loss 4:1. A. 56,000. B. 14,000. Total rupees 70,000. Difference between charge against profit and appropriation of profit and loss. Points of difference: charge against profit, appropriation of profit and loss. Number 1. Principle of matching concept. Charge against profit. The principle of matching concept is applicable. Appropriation of profit and loss. The principle of matching concept is not applicable. Number 2. Entry. Charge against profit. Charge against profit is recorded at the debit side of profit and loss account. Appropriation of profit and loss. Appropriation of profit is recorded at debit side of profit and loss appropriation account. Number 3. When to record. Charge against profit. In all circumstances, irrespective of profit or loss, full amount is recorded. Appropriation of profit and loss. Only in circumstances of profit, appropriation is recorded, no recording in case of loss. Number 4. Priority. Charge against profit. Expense are recorded before appropriation of profit. Appropriation of profit and loss. Appropriation is done after recording all expenses. Number 5. Illustration. Charge against profit. Interest on capital's loan. Rent payable to partner. Commission to manager. Appropriation of profit and loss. Interest on capital. Commission to partner. Transfer profit to general reserve. Number 11. Exclusive illustration. Illustration 1. Hiral withdraws rupees 500 in the beginning of every month. If 10% per annum interest is chargeable on drawings, determine annual drawings and interest on drawings. Answer. Total annual drawings is equals to 500 multiplied by 12 is equals to rupees 6,000. Interest on drawings is equals to I is equals to PRN upon 100 is equals to 500 multiplied by 10 upon 100 multiplied by 78 upon 12 is equals to rupees 325, where I is equals to interest, P is equals to principal amount, R is equals to rate of interest, N is equals to number of years. Explanation. Table showing computation of interest of monthly drawings. Month. Drawings in the beginning of every month. Drawings at the end of every month. Month first. Drawings in the beginning of every month 12. Drawing at the end of every month 11. Month 2. Drawings in the beginning of every month 11. Drawing at the end of every month 10. Month 3. Drawings in the beginning of every month 10. Drawings at the end of every month 9. Month 4. Drawings in the beginning of every month 9. Drawings at the end of every month 8. Month 5. Drawings in the beginning of every month 8. Drawing at the end of every month 7. Month 6. Drawings in the beginning of every month 7. Drawing at the end of every month 6. Month 7. Drawings in the beginning of every month 6. Drawing at the end of every month 5. Month 8. Drawings in the beginning of every month 5. Drawing at the end of every month 4. Month 9. Drawings in the beginning of every month 4. Drawings at the end of every month 3. Month 10. Drawings in the beginning of every month 3. Drawings at the end of every month 2. Month 11. Drawings in the beginning of every month 2. Drawings at the end of every month 1. Month 12. Drawings in the beginning of every month 1. Drawings at the end of every month 0. Interest of total months. Drawings in the beginning of every month 78. Drawing at the end of every month 66. From the above table, it can be ascertained that number 1. If drawings are done in the beginning of every month, interest will be calculated for 78 months. That is, n is equals to 78 upon 12. Number 2. If a drawing is done at the end of every month, interest will be calculated for 66 months. That is, n equals to 66 upon 12. Above stated interest on drawings under product method will be calculated as under. The computation of above mentioned illustration can be done as follows. Date of drawing, amount multiplied by months is equals to principal under method. 1st April 2016, 500 multiplied by 12 is equals to 6000. 1st May 2016, 500 multiplied by 11 is equals to 5500. 1st June 2016, 500 multiplied by 10 is equals to 5000. 1st July 2016, 500 multiplied by 9 is equals to 4500. 1st August 2016, 500 multiplied by 8 is equals to 4000. 1st September 2016, 500 into 7 is equals to 3500. 1st October 2016, 500 multiplied by 6 is equals to 3000. 1st November 2016, 500 multiplied by 5 is equals to 2500. 1st December 2016, 500 multiplied by 4 is equals to 2000. 1st January 2017, 500 multiplied by 3 is equals to 1500. 1st February 2017, 500 multiplied by 2 is equals to 1000. 1st March 2017, 500 multiplied by 1 is equals to 500. Total 39,000. Interest on drawings is equals to 39,000 multiplied by 10 upon 100 multiplied by 1 upon 12 is equals to rupees 325. Illustration 2. Hansa, Hitesh and Vijay are partners of a firm. Their capital proportion is 3:2:1. Hitesh is entitled to receive commission 10% of net profit after deduction of his share. What amount will be received by Hitesh when profit of the firm is rupees 1,65,000 at the end of the year? Answer. Assume profit after commission is rupees 100, where commission is rupees 10. Thus, profit before commission will be rupees 110, that is 100 plus 10, where commission is rupees 10. Commission is equals to profit multiplied by percentage of commission divided by 100 plus percentage of commission. That is, commission is equals to 1,65,000 multiplied by 10 divided by 110 is equals to rupees 15,000. That is, profit after commission, that is, divisible profit is equals to total profit minus commission is equals to 1,65,000 minus 15,000 is equals to 1,50,000. This will be distributed between partners in equal proportion. So, the share of Hitesh in profit will be rupees 50,000. Therefore, total amount received by Hitesh is equals to rupees 50,000 profit plus rupees 15,000 commission is equals to rupees 65,000. Illustration 3. The profit loss sharing ratio of Rajkumar, Kaushik and Sharma is 15:10:9. The total profit of the year firm is rupees 68,000. Determine the share in profit of each partner. Distribution of profit. Profit received by Rajkumar is equals to rupees 68,000 multiplied by 15 divided by 34 is equals to rupees 30,000. profit received by Kaushik is equals to rupees 68,000 multiplied by 10 divided by 34 is equals to rupees 20,000. Profit received by Sharma is equals to rupees 68,000 multiplied by 9 divided by 34 is equals to rupees 18,000. Illustration 4. Sheila, Surbhi and Seema are partners sharing profit loss in the ratio of 5:7:9. Manager Sanket is entitled to receive 10% commission from profit after deduction of his commission. Surbhi receives share in profit rupees 7,000. Determine the amount of commission of Sanket. Also determine amount of profit before the commission of manager. Answer. Number 1. Manager is entitled to get commission from the profit after the deduction of his own commission. It means commission will be calculated on divisible profit. Surbhi receives rupees 7,000 of divisible profit for her share of 7/21. Assume total profit of the firm is 1. Thus, 7/21 share of Surbhi is equals to total profit of firm is equals to rupees 1. Therefore, rupees 7,000 share of Surbhi is equals to total profit is equals to 1/1 multiplied by 7,000 into 21 whole upon 7 is equals to rupees 21,000 divisible profit. Number 2. Manager Sanket is entitled to get 10% commission from the divisible profit is equals to rupees 21,000 multiplied by 10/100 is equals to rupees 2,100. Number 3. Profit before commission of manager is equals to divisible profit plus commission of manager is equals to rupees 21,000 plus rupees 2,100 is equals to rupees 23,100. Illustration 5. Riya, Dilip and Kirtan are partners of a partnership firm. The share of Kirtan is 1/5 of share of Dilip and share of Riya is double of share of Kirtan. Determine the amount of profit of each partner. If the profit of the firm at the end of the year was rupees 1,92,000. Answer. Assume Dilip's share of profit rupees 1. Share of Kirtan is 1/5 of Dilip means 1/5 of 1 is equals to 1/5. While share of Riya is double of the share of Kirtan, double of 1/5 that is 1/5 multiplied by 2/1 is equals to 2/5. Therefore, share of Riya 2/5, Dilip 1/1 and Kirtan 1/5. Thus, proportion of distribution of profit between partners, Riya is to Dilip is to Kirtan, that is 2:5:1. The distribution of profit will be as follows. Profit of Riya is equals to 1,92,000 multiplied by 2/8 is equals to rupees 48,000. Profit of Dilip is equals to 1,92,000 multiplied by 5/8 is equals to rupees 1,20,000. Profit of Kirtan is equals to 1,92,000 multiplied by 1/8 is equals to rupees 24,000. Illustration 6. Milan, Hemant and Rasik have distributed profit of the firm of rupees 1,89,000 in equal proportion instead of distributing it in 1:2:4 proportions. To rectify this mistake, what treatment will be given to the capital account? Particular. Correct distribution of profit in the proportion of 1:2:4. Milan, rupees 27,000. Hemant, rupees 54,000. Rasik, rupees 1,08,000. Incorrect distribution of profit in the proportion of 1:1:1. Minus 63,000. Minus 63,000. Minus 63,000. Amount of difference. Milan, minus 36,000 debit. Hemant, minus 9,000 debit. Rasik, plus 45,000 credit. Rectification of error. An excess credit to Milan's and Hemant's account is rupees 36,000 and rupees 9,000 respectively, and rupees 45,000 are less credited to Rasik's account. So, Rasik's account will be credited and Milan's and Hemant's capital account will be debited. Date, particular, ledger folio number, debit amount, credit amount. Milan's capital or current account debit 36,000, Hemant's capital or current account debit 9,000, to Rasik's capital or current account. Being profit credited in wrong proportion is corrected. 45,000. Illustration 7. Ram, Rahim and Isu are partners of a firm. Their capital as on 1st April 2016 was Rs 60,000, 40,000 and 50,000 respectively. After the distribution of the profit of the year, it was realized that charging of 6% interest on partners' capital accounts was missed out. Write an entry for the rectification of error. Particulars: interest on capital at 6%, Ram, Rs 3,600, Rahim, Rs 2,400, Isu, Rs 3,000, total Rs 9,000. Reduction in profit equal to amount of interest on capital 1:1:1, Ram minus 3,000, Rahim minus 3,000, Isu minus 3,000, total minus 9,000. Amount of difference credit or debit: Ram 600 credit, Rahim Rs 600 debit, Isu 0. Rahim's capital or current account debit 600 to Ram's capital or current account 600. Being the computation of interest on capital at 6% was missed out, is rectified. Illustration 8. Yusuf, Harun and Kodawala are partners sharing profit and loss in the proportion of 3:2:1. Yusuf and Harun have given assurance to Kodawala to give minimum Rs 36,000 from profit. If for the year ending on 31st March 2016, total profit of the firm was Rs 1,80,000, how profit will be distributed among the partners? Answer. Distribution of profit. Yusuf, Rs 1,80,000 multiplied by 3/6 is equals to Rs 90,000. Harun, Rs 1,80,000 multiplied by 2/6 is equals to Rs 60,000. Kodawala, Rs 1,80,000 multiplied by 1/6 is equals to Rs 30,000. It was assured by Yusuf and Harun to Kodawala that he will receive at least Rs 36,000 from profit. But deficit to Kodawala is Rs 6,000, that is Rs 36,000 minus Rs 30,000 will be given to Kodawala by Yusuf and Harun in their profit-loss sharing ratio. Amount of profit to be given to Kodawala: Yusuf, Rs 6,000 multiplied by 3/5 is equals to Rs 3,600. Harun, Rs 6,000 multiplied by 2/5 is equals to Rs 2,400. Amount of distributable profit amongst the partners. Particular: distribution of profit in the profit-loss sharing ratio 3:2:1. Yusuf, Rs 90,000. Harun, Rs 60,000. Kodawala, Rs 30,000. Total, Rs 1,80,000. Payable and receivable amount. Yusuf, minus 3,600. Harun, minus 2,400. Kodawala, plus 6,000. Actual distribution of profit. Yusuf, Rs 86,400. Harun, Rs 57,600. Kodawala, Rs 36,000. Total, Rs 1,80,000. Illustration 9. The closing capital of a partner, Girish, is Rs 96,000 after giving effect of drawings of 6,000 and divisible profit of 9,000. Calculate 8% per annum interest on capital. Answer. Interest on capital is always calculated on the opening balance. Here, closing capital is provided. From that, opening capital will be ascertained as follows. Opening capital is equals to closing capital plus drawings minus profit. Closing capital is equals to Rs 96,000 plus drawings Rs 6,000 is equals to Rs 1,02,000 minus profit Rs 9,000. Opening capital Rs 93,000. So interest on capital is equals to Rs 93,000 multiplied by 8/100 is equals to Rs 7,440. Or Girish's capital account. On the debit side, to drawings account, Rs 6,000. On the credit side, by balance brought down, opening capital, Rs 93,000. On the debit side, to balance carried down, closing capital, Rs 96,000. On the credit side, by profit and loss account, profit, Rs 9,000. Total of debit side, 1,02,000. Total of credit side 1,02,000. So interest on capital is rupees 7,440. Illustration 10. A, B and C are the partners sharing profit and loss in equal proportion. Their total capital is of rupees 4,50,000. Their proportion of capital is 1:3:2. Firm pays interest on capital at 9% per annum. Partner C has received rupees 73,500 including interest on capital. Determine the amount payable including interest on the capital of A and B. Answer. Particulars. Partner's capital in the proportion of 1:3:2. A. Rupees 75,000. B. Rupees 2,25,000. C. Rupees 1,50,000. Interest on capital at 9% per annum. Divisible profit 1:1:1. A. Rupees 6,750. Rupees 60,000. B. Rupees 20,250. Rupees 60,000. C. Rupees 13,500. Rupees 60,000. Amount received including interest on capital. A. Rupees 66,750. B. Rupees 80,250. C. Rupees 73,500. Therefore, including interest on capital, A would receive rupees 66,750 and B rupees 80,250. Illustration 11. Harpal and Chirag are the partners of a firm. On 1st April 2016, their capital is rupees 60,000 and rupees 1 lakh respectively. During the year on 1st April 2016, Harpal has withdrawn rupees 15,000 and Chirag has withdrawn rupees 20,000 on 1st January 2017. Provisions of partnership deed are as follows. Number 1. Provide 12% per annum interest on capital. Number 2. Charge 9% per annum interest on drawings. Number 3. Rupees 1,000 per month are payable to Harpal for his active role in the firm, while 5% commission of divisible profit is payable to Chirag. On 1st December 2016, Harpal has given loan rupees 30,000 to the firm. There is no provision on loan in the partnership deed. He claims 11% interest on his loan. The profit of the firm on 31st March 2017 was rupees 79,400 before above mentioned provisions, but after charging interest on loan of Harpal. From the above information, prepare profit and loss appropriation account and partners capital accounts. Answer. Profit and loss appropriation account of the firm of Harpal and Chirag's for the year ending on 31st March 2017. On debit side, to interest on capital at 12%, Harpal 7,200, Chirag 12,000, total rupees 19,200. To salary, rupees 1,000 multiplied by 12, Harpal rupees 12,000. To commission at 5%, Chirag 2,500. To capital account, divisible profit 1:1, Harpal 23,750, Chirag 23,750. Total 47,000. Total of debit side 81,200. On the credit side, by profit and loss account, net profit 79,400. By interest on drawings, Harpal 1,350, Chirag 450. Total rupees 1,800. Total on credit side 81,200. Partners capital accounts. Debit credit. 1st April 2016 to drawings account, Harpal rupees 15,000. 1st April 2016 by balance brought down, Harpal rupees 60,000, Chirag rupees 1 lakh. 1st January 2017 to drawings account, Chirag rupees 20,000. 31st March 2017 by interest on capital account, Harpal rupees 7,200, Chirag rupees 12,000. 31st March 2017 to interest on drawings account, Harpal 1,350, Chirag rupees 450. 31st March 2017 by salary account, Harpal rupees 12,000. 31st March 2017 to balance carried down, Harpal rupees 86,600, Chirag rupees 1,17,800. Total, Harpal rupees 1,02,950, Chirag rupees 1,38,250. 31st March 2017 by commission account Chirag rupees 2,500. 31st March 2017 by profit and loss appropriation account divisible profit Harpal rupees 23,750, Chirag rupees 23,750. Total Harpal rupees 1,02,950, Chirag rupees 1,38,250. 1st April 2017 by balance brought down Harpal rupees 86,600, Chirag rupees 1,17,800. Explanation. Number 1. No clarification pertaining to capital account method is given in the problem. Thus, capital accounts are prepared on the basis of fluctuating capital account method. Number 2. To determine interest on drawings, date of drawings is considered. 1. Harpal has withdrawn rupees 15,000 on 1st April 2016. Thus, annual interest is to be calculated for his drawings. 2. Interest on drawings of Chirag will be calculated for 3 months from 1st January 2017 to 31st March 2017. Number 3. On 1st December 2016, Harpal has given loan to the firm. 4 months interest on this loan will be calculated at 6% per annum, which is debited to profit and loss account and will be shown at capital liabilities side of balance sheet. Number 4. No clarification is made for profit-loss sharing ratio between the partners. Therefore, divisible profit is to be distributed amongst the partners in equal proportion. Illustration 12. Sudhanshu and Sarvesh are partners of a firm. Their profit and loss sharing ratio is 3:2. The capital of partners as on 1st April 2016 was rupees 90,000. This is fixed capital. Capital of partners is in the proportion of 5:4. Drawings of the partners during the year were as follows. Sudhanshu rupees 6,000 on 1st July 2016. Sarvesh rupees 4,000 on 1st October 2016. There is provision in partnership deed to pay interest on capital at 8% per annum and to charge interest on drawings at 12% per annum. On 1st April 2016, balances in current accounts of partners is rupees 3,000 credit balance and rupees 2,000 debit balance respectively for Sudhanshu and Sarvesh. Interest at 6% per annum on opening balance of current account is to be calculated. Sudhanshu is to be paid 5% commission on profit after deduction of his commission from profit. Before considering the above mentioned adjustments, profit of the firm for the year ending on 31st March 2017 is rupees 37,770. From this information, prepare a profit and loss appropriation account, partners' capital accounts and current accounts. Answer. Profit and loss appropriation account for the year ending on 31st March 2017 of firm of Sudhanshu and Sarvesh. Debit side, to interest on capital account, Sudhanshu 4,000, Sarvesh 3,200. Total rupees 7,200. To interest on current account, Sudhanshu 180. To commission account, Sudhanshu 1,490. To partners current account, divisible profit, Sudhanshu 17,880. Sarvesh 11,920. Total rupees 29,800. Total of debit side 38,670. On credit side, by profit and loss account, net profit rupees 37,770. By interest on drawings account, Sudhanshu 540, Sarvesh 240. Total rupees 780. By interest on current account, Sarvesh rupees 120. Total of credit side 38,670. Partners capital accounts. On the debit side, 31st March 2017, to balance carried down, Sudhanshu rupees 50,000, Sarvesh rupees 40,000. On the credit side, 1st April 2016, by balance brought down, Sudhanshu 50,000, Sarvesh 40,000. Partners current accounts. On the debit side, 1st April 2016, to balance carried down, Sarvesh rupees 2,000, 1st July 2016, to drawings account Sudhanshu rupees 6,000. 1st October 2016 to drawings account Sarvesh rupees 4,000. 31st March 2017 to interest on current account Sarvesh rupees 120. 31st March 2017 to interest on drawing account Sudhanshu rupees 540. Sarvesh rupees 240. 31st March 2017 to balance account Sudhanshu rupees 20,010. Sarvesh rupees 8,760. Total of debit side of Sudhanshu rupees 26,550. Total of debit side of Sarvesh rupees 15,120. On the credit side, 1st April 2016 by balance brought down Sudhanshu rupees 3,000. 31st March 2017 by interest on capital account Sudhanshu rupees 4,000. Sarvesh rupees 3,200. 31st March 2017 by interest on current account Sudhanshu rupees 180. 31st March 2017 by commission account Sudhanshu rupees 1,490. 31st March 2017 by profit and loss appropriation account Sudhanshu 17,880. Sarvesh 11,920. Total of credit side Sudhanshu rupees 26,550. Sarvesh rupees 15,120. Explanation. Number 1. The opening total capital of partners is rupees 90,000. It is in the proportion of 5:4, so capital of Sudhanshu is of rupees 50,000 and rupees 40,000 of Sarvesh. This capital is considered as fixed capital and interest on capital is calculated on these amounts. Number 2. Interest on drawings. Sudhanshu for 9 months from 1st July 2016 to 31st March 2017. Sarvesh for 6 months from 1st October 2016 to 31st March 2017. Number 3. 5% commission on profit is payable to Sudhanshu, but after deduction of such commission from profit. Assume profit after commission is rupees 100, where commission will be rupees 5. Therefore, profit before deduction of commission will be rupees 105, that is 100 plus 5, where rupees 5 commission is included. Therefore, commission of Sudhanshu is equals to 31,290 multiplied by 5 divided by 105. Total of credit side of profit and loss appropriation account is rupees 38,670. Interest on capital is equals to rupees 7,200 plus interest on current account rupees 180 is equals to rupees 31,290 is equals to 1,490. Number 4. Profit after commission, that is divisible profit, is equals to rupees 29,800, that is rupees 31,290 minus rupees 1,490 will be distributed amongst the partners in the ratio of 3:2. Divisible profit of Sudhanshu is equals to rupees 29,800 multiplied by 3 upon 5 is equals to rupees 17,880. Divisible profit of Sarvesh is equals to rupees 29,800 multiplied by 2 upon 5 is equals to rupees 11,920. Illustration 13. Bhadresh and Hiral are the partners of a firm. Their profit and loss sharing ratio is 3:2. 1st April 2016, total capital of partners was rupees 4,20,000. The proportion of their fixed capital is 4:3. On this day, balances of their current accounts are as follows. Bhadresh rupees 36,000 credit, Hiral rupees 24,000 debit. As per partnership deed, per annum 12% interest is payable on the capital of the partners. Provide per annum 10% interest on opening balances of the current accounts. Per annum 12% interest is to be charged on drawings. Rupees 2,400 per month as a salary are payable to Bhadresh for his active role in the firm. On 1st October 2016, Bhadresh has withdrawn rupees 36,000 and on 1st January 2017, Hiral has withdrawn rupees 48,000. 10% commission on net profit is payable to Hiral from net profit, but after deduction of his such share from net profit. Before consideration of above mentioned adjustments, the profit of the year ending on 31st March 2017 of the firm was Rs 4,06,800. From the above information, prepare profit and loss appropriation account and partners' capital accounts and current accounts as per the fixed capital account method. Answer. Profit and loss appropriation account of the firm of Bhadresh and Hiral for the year ending on 31st March 2017. On the debit side, to interest on capital at 12%, Bhadresh 28,800, Hiral 21,600. Total Rs 50,400. To interest on current account at 10%, Bhadresh Rs 3,600. To salary account Rs 2,400 into 12, Bhadresh Rs 28,800. To commission at 10%, Hiral Rs 30,000. To current account, divisible profit 3:2, Bhadresh 1,80,000, Hiral 1,20,000. Total Rs 3 lakhs. Total of debit side is 4,12,800. On credit side, by profit and loss account, net profit Rs 4,06,800. By interest on current account at 10%, Hiral Rs 2,400. By interest on drawing at 12%, Bhadresh 2,160, Hiral 1,440. Total Rs 3,600. Total of credit side 4,12,800. Partners capital account on debit side, date 31st March 2017, to balance carried down, Bhadresh Rs 2,40,000, Hiral Rs 1,80,000. On the credit side, date 1st April 2016, by balance brought down, Bhadresh 2,40,000, Hiral 1,80,000. On credit side total, 1st April 2017, by balance brought down, Bhadresh 2,40,000, Hiral 1,80,000. Partners current accounts. On debit side, date 1st April 2016, to balance carried down, Hiral Rs 24,000. 1st October 2016, to drawings account, Bhadresh 36,000. 1st January 2017, to drawings account, Hiral 48,000. 31st March 2017, to interest on current account, Hiral 2,400. 31st March 2017, to interest on drawings account, Bhadresh 2,160, Hiral 1,440. 31st March 2017, to balance carried down, Bhadresh Rs 2,39,040, Hiral 95,760. Debit side total of Bhadresh Rs 2,77,200. Total of debit side on Hiral's account Rs 1,71,600. On credit side, date 1st April 2016, by balance brought down, Bhadresh 36,000. 31st March 2017, by interest on capital account, Bhadresh 28,800, Hiral 21,600. 31st March 2017, by interest on current account, Bhadresh 3,600. 31st March 2017, by salary account, Bhadresh 28,800. 31st March 2017, by commission account, Hiral 30,000. 31st March 2017, by profit and loss appropriation account, divisible profit, Bhadresh 1,80,000, Hiral 1,20,000. Total on credit side of Bhadresh 2,77,200. Total on credit side of Hiral 1,71,600. 1st April 2016, by balance brought down, Bhadresh Rs 2,39,040, Hiral Rs 95,760. Illustration 14. Shruti, Kashvi and Mary are partners of a firm. Total balance of their fixed capital on 1st April 2016 was Rs 2,50,000. It was in the proportion of 2:2:1. Balances of their current accounts were as follows. Shruti Rs 24,000 credit, Kashvi Rs 18,000 debit and Mary Rs 12,000 credit. Provisions of partnership deed were as follows. Number 1. 3:5 of profit to be distributed in the proportion of 3:2:1 and remaining in the proportion of their opening capital. Number 2. Provide per annum 10% interest on capital. Number 3. Provide per annum 8% interest on opening balance of current account. Number 4. Monthly salary of Rs 500 is payable to Kashvi. Number 5. 12% per annum interest is chargeable to drawings of partners. Shruti has withdrawn Rs 18,000 on 1st February 2017, Kashvi Rs 12,000 on 30 November 2016 and Mary Rs 20,000 on 1st October 2016. Mary has introduced additional capital Rs 24,000 on 1st January 2017. 5% amount of net profit is to be transferred to the development fund but not more than Rs 6,000. Then after 10% commission on net profit is payable to Mary, but from profit after deduction of such her commission. Profit of the firm for the year ending on 31st March 2017 after credit of interest on drawings but before incorporation of other adjustments was Rs 1,71,040. From the above information, prepare profit and loss appropriation account for the year ending 31st March 2017 and partners' capital accounts and current accounts under fixed method. Answer. Profit and loss appropriation account for the year ending on 31st March 2017 of partnership firm of Shruti, Kashvi and Mary. On debit side, to interest on capital account, Shruti 10,000, Kashvi 10,000, Mary 5,600. Total Rs 25,600. To interest on current account, Shruti 1,920, Mary 960. Total Rs 2,880. To salary account, Kashvi Rs 6,000. To development fund account, Rs 6,000. To commission account, Mary Rs 12,000. To partners current account, divisible profit, Shruti 55,200, Kashvi 43,200, Mary 21,600. Total Rs 1,20,000. Total of debit side 1,72,480. On credit side, by profit and loss account, net profit Rs 1,69,000. By interest on drawings, Shruti 360, Kashvi 480, Mary 1,200. Total Rs 2,040. By interest on current account, Kashvi 1,440. Total of credit side 1,72,480. Partners capital accounts. On debit side, 31st March 2017, to balance carried down, Shruti Rs 1 lakh, Kashvi Rs 1 lakh, Mary Rs 74,000. On credit side, 1st April 2016, by balance brought down, Shruti Rs 1 lakh, Kashvi Rs 1 lakh, Mary Rs 50,000. 1st January 2017, by cash account, Mary Rs 24,000. Total of credit side, Shruti Rs 1 lakh, Kashvi Rs 1 lakh, Mary Rs 74,000. Total of debit side, Shruti Rs 1 lakh, Kashvi Rs 1 lakh, Mary Rs 74,000. Partners current accounts. Debit, credit. On debit side, 1st April 2016, to balance carried down, Kashvi Rs 18,000. 1st October 2016, to drawings account, Mary Rs 20,000. 30 November 2016, to drawings account, Kashvi Rs 12,000. 1st February 2017, to drawings account, Shruti Rs 18,000. 31st March 2017, to interest on drawings account, Shruti Rs 360, Kashvi Rs 480, Mary Rs 1,200. 31st March 2017, to interest on current account, Kashvi Rs 1,440. 31st March 2017, to balance carried down, Shruti Rs 72,760, Kashvi Rs 27,280, Mary Rs 30,960. Total of debit side, Shruti Rs 91,120, Kashvi Rs 59,200, Mary Rs 52,160. On credit side, 1st April 2016, by balance brought down, Shruti Rs 4,000, Mary Rs 12,000. 31st March 2017, by interest on capital account, Shruti Rs 10,000, Kashvi Rs 10,000, Mary Rs 5,600. 31st March 2017, by interest on current account, Shruti rupees 1920, Mary, rupees 960. 31st March 2017, by salary account, Kashvi, rupees 6000. 31st March 2017, by commission account, Mary, rupees 12,000. 31st March 2017, by profit and loss appropriation account, divisible profit, Shruti, rupees 55,200, Kashvi, rupees 43,200, Mary, rupees 21,600. Total of credit side, Shruti, rupees 91,120, Kashvi, rupees 59,200, Mary, rupees 52,160. Explanation. Number 1. Profit of the firm for the year ending on 31st March 2017 after credit of interest on drawings, rupees 1,71,040. Total interest on drawings of all partners, rupees 2,040, that is, rupees 360 plus rupees 480 plus rupees 1,200, deducted from rupees 1,69,000, that is, rupees 1,71,040 minus rupees 2,040, and so net profit will be rupees 1,69,000. This is shown at credit side of profit and loss appropriation account. Number 2. Interest on capital of Mary. I is equals to PRN divided by 100. Interest on opening capital on rupees 50,000 is equals to rupees 50,000 multiplied by 10 multiplied by 1 divided by 100 is equals to rupees 5,000. Interest on additional capital on rupees 24,000. Interest for 3 months, that is 1st January 2017 to 31st March 2017 is equals to 24,000 multiplied by 10 divided by 100 multiplied by 3 divided by 12 is equals to rupees 600. Total interest of capital is equals to rupees 5,000 plus rupees 600 is equals to rupees 5,600. Number 3. Development Fund. Profit before development fund and commission of Mary is rupees 1,38,000. Total of the credit side of the profit and loss appropriation account is rupees 1,72,480 minus total of the debit side rupees 34,480. Therefore, development fund rupees 1,38,000 multiplied by 5 divided by 100 is equals to rupees 6,900. But this amount cannot exceed to rupees 6,000. Therefore, rupees 6,000 are transferred to the development fund. Number 4. Commission to Mary. A surplus of profit after transferring of rupees 6,000 to the development fund is rupees 1,32,000. Profit before commission rupees 110. Commission is equals to rupees 1,32,000 into 10 divided by 110 is equals to rupees 12,000. Number 5. Divisible profit is equals to rupees 1,32,000 minus rupees 12,000 is equals to rupees 1,20,000. Computation of divisible profit. Particular 3 upon 5 of rupees 1,20,000 in equal proportion rupees 72,000, that is 3:2:1. Shruti rupees 36,000, Kashvi rupees 24,000, Mary rupees 12,000, total rupees 72,000. Remaining rupees 48,000 in the proportion of opening capital 2:2:1. Shruti rupees 19,200, Kashvi rupees 19,200, Mary rupees 9,600, total rupees 48,000. Share of each partner in total divisible profit. Shruti rupees 55,200, Kashvi rupees 43,200, Mary rupees 21,600, total 1,20,000. Illustration 15. On 1st April 2016, Ranjana, Sushma and Joseph introduced capital of rupees 1,28,000, rupees 96,000 and rupees 80,000 respectively and commenced a business. Sushma has withdrawn rupees 8,000 on 1st October 2016, while Ranjana has withdrawn rupees 1,200 at the end of each month. As per the partnership deed, number 1. Provide 5% per annum interest on capital and charge 10% per annum interest on drawings. Number 2. Profit and loss sharing ratio among partner is 5:3:2. After incorporation of the above mentioned adjustment, 2% bonus is to be paid to Ranjana from the surplus of profit. On 31st March 2017, partners have decided that total capital of the firm after the incorporation of the above mentioned adjustments will be of Rs 3 lakh. Their credit balance of capital accounts will be in the ratio of 2:2:1. For this adjustment, necessary amount will be introduced or withdrawn by the partners. Net loss of the firm for the year ending on 31st March 2017 was of Rs 45,860. From the above information, prepare profit and loss appropriation account for the year ending on 31st March 2017 as well as partners' capital accounts and drawings accounts. Answer. Profit and loss appropriation account for the year ending on 31st March 2017 of partnership firm of Ranjana, Sushma and Joseph. On debit side, particular to profit and loss account, net loss Rs 45,860. To interest on capital, Ranjana 6,400, Sushma 4,800, Joseph 4,000. Total Rs 15,200. Total of debit side Rs 61,060. On credit side, by interest on drawings, Ranjana 660, Sushma 400. Total Rs 1,060. By partners capital account, divisible loss, Ranjana 30,000, Sushma 18,000, Joseph 12,000. Total Rs 60,000. Total of credit side is Rs 61,060. Partners capital account. On debit side, date 31st March 2017 to drawings account, Ranjana Rs 15,060, Sushma Rs 8,400. 31st March 2017 to profit and loss appropriation account, divisible loss, Ranjana Rs 30,000, Sushma Rs 18,000, Joseph Rs 12,000. 31st March 2017 to cash account, Joseph Rs 12,000. 31st March 2017 to balance carried down, Ranjana Rs 1,20,000, Sushma Rs 1,20,000, Joseph Rs 60,000. Total of debit side, Ranjana Rs 1,65,060, Sushma Rs 1,46,400, Joseph Rs 84,000. On credit side, date 1st April 2016 by cash account, Ranjana Rs 1,28,000, Sushma Rs 96,000, Joseph Rs 80,000. 31st March 2017 by interest on capital account, Ranjana Rs 6,400, Sushma Rs 4,800, Joseph Rs 4,000. 31st March 2017 by cash account, Ranjana Rs 30,660, Sushma Rs 45,600. Total of credit side, Ranjana Rs 1,65,060, Sushma Rs 1,46,400, Joseph Rs 84,000. Partners capital accounts. On debit side, 30 April 2016 to cash account, Ranjana Rs 1,200. 31st May 2016 to cash account, Ranjana Rs 1,200. 30 June 2016 to cash account, Ranjana Rs 1,200. 31st July 2016 to cash account, Ranjana Rs 1,200. 31st August 2016 to cash account, Ranjana Rs 1,200. 30 September 2016 to cash account, Ranjana Rs 1,200. 1st October 2016 to cash account, Sushma Rs 8,000. 31st October 2016 to cash account, Ranjana Rs 1,200. 30 November 2016 to cash account, Ranjana Rs 1,200. 31st December 2016 to cash account, Ranjana Rs 1,200. 31st January 2017 to cash account, Ranjana Rs 1,200. 28 February 2017 to cash account, Ranjana Rs 1,200. 31st March 2017 to cash account, Ranjana Rs 1,200. 31st March 2017 to interest on drawings, Ranjana Rs 660, Sushma Rs 440. Total of debit side, Ranjana Rs 15,060, Sushma Rs 8,400. On credit side, date 31st March 2017 by capital account, Ranjana Rs 15,060, Sushma Rs 8,400. Total of credit side, Rs 15,060, Sushma Rs 8,400. Explanation. Number 1. Interest on drawings of Ranjana is equals to 1200 multiplied by 10 upon 100 multiplied by 66 upon 12 is equals to rupees 660. Number 2. There is divisible loss at the end of the year, so Ranjana will not get bonus. Number 3. Total closing capital rupees 3 lakh is to be maintained in the ratio of 2:2:1, which is rupees 1,20,000, rupees 1,20,000 and rupees 60,000 respectively. To maintain this capital, Ranjana and Sushma will bring deficit of rupees 30,660 and rupees 45,600 in cash respectively, while Joseph will withdraw excess capital of rupees 12,000. Limited Liability Partnership. As per the Partnership Act 1932, the business liability of the partners of the firm is unlimited. The Limited Liability Partnership Act 2008 has been introduced as a new scheme to mobilize the small-scale and medium-scale industries of India, as well as to eliminate the limitation of unlimited liability of partners of a partnership firm. This form of business has the characteristics similar to partnership firms and companies. In this form of business, the liability of partners is similar to the liabilities of the shareholders in the companies. In this form of business, there should be minimum number of partners. Each partner of such business would be same as the agent of LLP, that is Limited Liability Partnership, but its scope will not be treated as the agent of other partner. The registration of LLP is mandatory.